avoid is systematic risk, which is that risk that you can't diversify your way out of. Think recession, interest rates, wars. What does it look like? It looks like this. This is 2008, where no matter where you went, there were going to be declines in the equity portfolio. US stocks were down 37%. REITs were down. So real estate was down 39%. Commodities, 35%. The only positive blip here was bonds, up 5%. Fast forward to 2022, where equities went down 20% and bonds went down 20% as well. This type of systematic risk is something that investors can't plan on. And that's why having an automated risk management solution like our 2.0 or 3.0 portfolios could be the perfect thing to keep them invested and allow them to take out high withdrawals during retirement.
So a couple other things is obviously using this platform and using what are called sector funds, those 11 sectors, very inexpensive, which is, let's face it, costs matter with portfolio. In my retirement income certified professional designation course studies, one of the things that they hammered on significantly again and again and again was what is a safe withdrawal rate? How much of our portfolio can we withdraw every year if we're planning on lasting for 30 to 35 years? And in fact, there's a latest statistic for if someone is 73 when they start taking their income out, according to the Bureau of Labor Statistics, the most recent information, and this is both male and female, by the way. So ladies, thanks very much for helping us guys a little bit on this. But for a 73-year-old, the life expectancy, the halfway point when half of those 73-year-olds will be dead and half of them will still be alive, is another 26.7 years, or in other words, 99.7. The reason I bring that up, it doesn't matter what your life expectancy was of your parents, your grandparents. It's a whole new world out there and a whole new generations. And this is why it's critically important that you keep both real estate, investment real estate, and that's another topic, and you can find lots of stuff on our website about that and how to integrate investment real estate without having to own it directly. But this is why you also need to keep equities in a portfolio. Now, there are different flavors, and Beacon has different flavors as far as how much of the portfolio gets into the equity sleeve. But the important thing is we need to keep equities in our portfolios for the rest of our lives, because we're going to live, most of us live a whole lot longer than we've ever imagined. Can you picture your portfolio lasting to age 100 with confidence that you're not going to run out of money?
So for a retiree, depending on the year they retire, could determine a successful retirement or not. What's on the screen here are the sequence of returns for the S&P 500 from 2000 to 2022, except we put them in reverse order. So if a person retires here in the first year, they have a negative 18% return followed by a positive 28%, all the way down to 2000. They have a 7.94% average rate of return. If they put $1 million into this portfolio and they're taking out withdrawals, everything works out fine. They end up with 1.6 million. But if we look at these returns in the exact order that they happened from 2000 to 2022, this same investor who started with $1 million runs out of money by 2015. And this is sequence of return risk. And this is one of the main things we're trying to address with the Beacon risk management portfolios.